Good morning, everyone, and welcome to my channel. In this channel, I'm creating a series of videos in which I'll be using ICT concepts, the inner circle trader concepts, to trade in the Indian stock market, especially in the futures market. Just a quick disclaimer, I'm not recommending any instruments to trade in, and I'll not show any P&L statements of mine. I'm from India, not trying to sell any course here, just making a free video channel for me and my loved ones, which will exactly show you that ICT concepts works in the Indian markets also. If you don't believe me, it's fine. I don't mind. I know there are a lot of scammers now in YouTube trying to take away your money, so I get it. If you don't believe in me, then it's okay if you don't watch my channel. So let's begin and understand what exactly are the ICT concepts that Michael J. Huddleston, the author of ICT and my mentor, has created. So I'll be teaching you these concepts which I think has been successful for me in my trading journey. Not saying that the other concepts of ICT are not good, but in the end, ICT himself says that he has a lot of PD arrays. PD arrays are these concepts. Okay. So he himself says there are maybe 81 PD arrays of him. So you don't need to understand all of them to be profitable. So here are the simple concepts which I think are sufficient for trading ICT concepts in the Indian markets. First of all, what is a candle or the candle formation theory? Okay, I've already uploaded this video in my YouTube channel. You can check that out later. So this is the main basis of any technical analysis, be it ICT, support, resistance, trend line, anything. So you need to understand what is a candle, how a candle is formed, what is open, what is high, what is low, what is close of a candle. These four concepts, open, high, low, close, as well as open, low, high, close, will determine a candle, whether a candle will be bullish candle or a bearish candle. Okay. The second is the market structure. So as I mention all this, I'll give you a quick preview of what are all these things. Okay. So first of all, regarding candles, so as you can see, the black candles are actually the bearish candles, which are, I guess, in your chart, the red candles, and the green candles are the bullish candles. Okay. So open, low, high, this is close. Similarly, in bullish candle, this is open, this is low, this is high, and this is close. That's it. So in-depth knowledge of this has been uploaded in my YouTube channel. So kindly refer to that. So next is our, just a second, I'll bring it closer. Next is our, what is a market structure? Correct? When the market is going long, okay, long means upward, a bullish trend. When the market is going long, it will keep forming higher highs and higher lows, and vice versa for shorts, lower highs and lower lows will be formed. Say, for example, this is a short scenario. As you can see, this is a swing low. The next low is lower than the previous low, okay? And then another one is this one, okay? So from here, there is a market structure. So I'll explain all these things, okay? I'm just removing it for now. So here, as you can see, this is a high. This, the next high is a higher high. Again, the next high is a higher high. Also, the lows will be, this is a low, swing low. This is a higher low. This is also a higher low. Correct? So while shorts, there will be lower lows and lower highs. These are the lower highs. In longs, there will be higher highs and higher lows. Okay? So this is the market structure. So what is a market structure shift? So you can see here, price is in shorts going low, and then when there is a shift in market structure, we form a market structure shift. Okay, so at this point, the market started shifting its structure from lower lows to higher lows, or lower highs to higher highs. So here it was shorting, the market was in shorts, and here the market is in longs. So that's it. That's the market structure shift. So coming to the liquidity. Liquidities are actually, in my simple concept, these are all lows and all highs. So these are areas where most traders place their stop losses. And according to ICT concepts, the algorithm that is working in the market, so according to the algorithm, price moves to hunt these liquidities. Okay. So while coming down, there were these liquidity. This was a liquidity as well as this liquidity. So price went up to hunt this liquidity. So below also, while going up, this is a liquidity, price came to hunt it. This is another liquidity. Okay. This is another liquidity. So price comes and hunts these swing lows and swing highs. Okay. So while coming down, these highs were points of liquidity. Okay. So price went up to hunt them. Simple fact, while shorting, we will place our stop loss in this swing highs. So market turns and hunts our stop losses. So that's liquidity. So coming to the fair value gap, these are one of the most important concepts of ICT, which has made me a great amount of success in my trading journey. Fair value gaps are areas of inefficiencies. So for example, there is a huge amount of money that is put in the market. So price creates an area of imbalance or inefficiency. For example, I'll show you. In fair value gap, we have three candles. This is the first candle, this is our second candle, and this is our third candle. This is our third candle. Okay. So when there is a gap between the first and the third candle, so we have an inefficiency. So this is called a fair value gap. Okay. So price usually comes down to these areas of inefficiencies to make price more efficient. Okay. Similarly, here you can see this is a fair value gap. Price came here and then it went up. This is a fair value gap. Price came here and then went up. Okay. So these are fair value gaps. So we'll learn about this concept in the next video which I'll upload. So kindly stay tuned for that video. There are inverse fair value gaps also, as I've written here, iFVG. iFVG means there is an inverse trait to a fair value gap. For example, this is a bearish fair value gap. So when price goes above it, it can come down and this will act as a bullish fair value gap, right? Coming to the volume imbalance, this is another great concept of ICT. So between two candles, if the bodies have a gap in between them. For example, say this candle and this candle, there are no gaps in between the closing of this previous candle and the opening of this second candle. But as you can see, in these two candles, price opened here, it went up and it closed here, but then this price opened here. So we can observe a volume imbalance in this area. Okay, so price usually comes down to this volume imbalance and then goes away. See, so these are again areas of imbalances in price action, which the market tries to fill them so as to provide efficient price action throughout the day. Okay, so we'll study more about this in the next videos. Coming to our order block and breaker blocks. So breaker block is a form of inverse order block. So there are bullish order block as well as bearish order block. For example, say this down close candles before a move up is a bullish order block. So this is a bullish order block. Okay. So as price comes down here after breaking, it goes up, right? So I'll let you see a bearish order block here. So this is a bearish order block. Okay. So see price, this is a series of up close candle. Price comes down and then again hits these candles and then falls down. So this is a bearish order block. More about these order blocks and breaker blocks I'll explain in my later videos. So no need to understand it right now because I'm just giving you an overview of everything. Okay. So I use these 9 concepts of ICT in combination when I'm trading, and it's better if you have at least 3 confluences aligning to your bias. For example, if I'm trying to long here, we have a market structure shift here, right? We have this market structure shift one. We have this fair value gap, bullish fair value gap, as well as we have this inverse fair value gap. Okay. Also, we have this bullish order block. So these are confluences which are adding together. And then if I take a trade here in my fair value gap, also we remember we have this volume imbalance here, and I place my stop loss at this low. So I can easily target a 1 is to 2. So this is a 1 is to 2. Correct? So that's it for now. Uh, in the next video, we'll discuss about the fair value gap as well as the volume imbalance, or maybe I'll make separate videos of both of them. So make sure to subscribe to this channel, share it with your trading friends who are using ICT concepts or who think of using ICT concepts, as these concepts will give you a better understanding of why price is moving and where price is moving to. Okay, so drop a comment if you want me to break down your charts using ICT concepts. I'll see if I can do that. So see you in the next one. That's it. Goodbye.